Hi, Merry Christmas, and welcome to the mid-December stock investment update. How to build a zero-loss portfolio. So let's start with a quick overview of the returns in December. My investment account number one, using the long-term trading strategy, had a return of 5% in December. My investment account number two, using the monthly adjustment strategy, had a return of around 5.5%. And my investment account number three, using the short-term trading strategy, had a return of around 11.5% in December. On the other hand, SPY had a return of around 4.6%, and QQQ had a return of around 5.25%. So here is a screenshot of my investment account number one, the long-term investing strategy. Notice that the account value in my investment account number one has now surpassed $19,000. Now it's more than $19,000. Here's a screenshot of my investment account number two, the monthly adjustment strategy. So in December, we were holding QQQM with 100% capital. And now for my investment account number three, the short-term trading strategy. In this account, we use a flagship short-term trading strategy. Note that in December, we are still continuing to hold UPRO. Okay, now let's continue on to the next section of um, today's stock investment review. How to build a no loss or zero loss portfolio. So here's a real life situation. My mom saved $8,000 for a vacation next Christmas. She doesn't want to invest it. She doesn't want to invest it in the stock market because she doesn't want to lose any money. Naturally, a good choice is to put $8,000 into short-term treasury bond ETFs such as SGOV or BIL. So SGOV and BIL both have dividends of around 5% annually so far. As you can see, here is an SGOV cumulative growth chart, dividends included over the past 2 years. Based on the current dividend yield of SGOV or BIL, the $8,000 will turn to about $8,400 by next Christmas. But can we get more returns while not increasing risk? Um, we can put some capital into a safe ETF, such as the S&P 500 Index ETFs, SPY, VOO, IVV, etc., while we put the remaining capital into SGOV. But can we find a better ETF or ETF portfolio than SPY or VOO or IVV? Actually, we can. Um, An example is an ETF portfolio of 50% QQQ and 50% SCHD. So I'm assuming most of you are familiar with QQQ, but some of you or many of you may not know what SCHD is. So what is SCHD? SCHD stands for the Schwab US Dividend Equity ETF. The fund's goal is to track as closely as possible the total return of the Dow Jones 100 index. This ETF invests in stocks selected for fundamental strength relative to the peers based on financial ratios. So here's a performance comparison between the ETF portfolio composed of 50% QQQ and 50% SCHD, SPY, and QQ since November 2011. Note that the initial invested capital is $100,000. So this performance comparison includes many different like metrics or financial metrics, and stuff. So one metric is the standard deviation. This is used to measure the dispersion of returns around the mean and is often used as a measure of risk. A higher standard deviation implies a higher potential risk of a portfolio. Another metric is the maximum drawdown. This is the maximum observed loss from a peak or like lowest point to from or highest point to a trough or lowest point of a portfolio before a new peak or high point is attained. A high maximum drawdown is a characteristic of a bad portfolio. So here's an example of how to tell the max drawdown. As you can see from this chart, the maximum drawdown is around 60%. And the final metrics is the Sharpe ratio. This is a measure of the risk-adjusted performance of the portfolio. And the larger the Sharpe ratio, the better a portfolio is. So measured in terms of risk, um, the ETF portfolio, composed of 50% QQQ and 50% SCHD, has almost the same risk as that of SPY, but has much less risk than QQQ. The ETF portfolio also has a higher compound annualized growth rate than SPY. As you can see, our portfolio has a compound annualized growth rate of 16%, while SPY has a compound annualized growth rate of around 13.6%. Um, so as you can see, our portfolio has around the same risk level as that of SPY, but it has a much higher return, which overall makes it in my opinion, a better portfolio. So the ETF portfolio is a better choice than SPY and QQQ in terms of both risk and return. Okay, now let's move on to step 2, deciding how much capital to be invested in the ETF portfolio. As you can see, the max drawdown of the ETF portfolio is negative 24%. So now let's consider the worst case scenario. If we invest 17% of if we invest the 17% of the $8,000 in the ETF portfolio and invest the remaining 83% of the $8,000 in SGOV, um, and like maybe it's a really bad year for the ETF portfolio. The maximum loss based on like historical data is about $8,000 times 17%. So we now know 17% of $8,000, which is invested in the ETF portfolio, times the maximum drawdown. So if the ETF portfolio had like a really bad year and had a loss of negative 24.09%, 0.09%, we would lose negative $227 from this ETF portfolio. So in this part of the portfolio, we would have lost $327. But remember that we invested the remaining 83% of the $8,000 in SGOV. So SGOV gives us dividends, and it will give us dividends of about $8,000 times 83%, which is how much we invested in SGOV, times 5%, which is its dividend amount or return. So SGOV will give us dividends of about $332. Note that $332 is more than $327. What this is telling us is that if we lose $327 from the ETF portfolio here, SGOV, or the remaining 83% of the 8,000 we invested in, will give us dividends of about $332, which will cancel out the $327. So even in the worst case scenario, we don't lose any money. Now let's consider an average case. Um, the 17% of the $8,000 invested in the ETF portfolio provides an average return of around 16%. So that's around $218. And the remaining 83% invested in SGV will give us dividends of about $332. So totally we have the following gain of about $550. This is equivalent to a around 7% return of the $8,000. Remember that if we had invested in only SGOV, we would have only had a 5% return. But if we invested in this gigantic portfolio of QQQ, SCHD, and SGOV together, we would have a much higher return of around 7%. And of course, using this portfolio, even in a really bad year, we would still not have lost any money. Now, let's finalize the no loss portfolio in step 3. So this is the overall portfolio I was talking about previously. In this portfolio, we have QQQ with 8.5% capital, SCHD with 8.5% capital, and SGOV with 83% capital. As you can see from the screenshot, I already invested in this portfolio and these ETFs already. So overall, here are some final words on the no loss or zero loss portfolio. This portfolio is designed based on historical data and current dividend yields. And it is designed for comparatively lazy people who have little investment knowledge and don't have time or don't want to spend that much time on investing. Um, this portfolio ensures positive returns with high probability, but of course, it can't be 100% guaranteed because, after all investments, no matter what, have risks. Like, all investments have risks. Um, so one can use this approach to design other portfolios for the next year or the next year or the years after that. So the important thing is to use your brain. And overall, Merry Christmas and see you next month. See you.